When most people think about the multi-trillion-dollar push to upgrade the global energy grid, they usually picture the shiny stuff.
Oh, absolutely. The highly visible monuments to modern infrastructure.
Right, like they visualize wind turbines touching the clouds, or just endless fields of gleaming solar panels, or, high voltage transmission lines cutting across the landscape.
I mean, it's what captures the imagination, and, well, it makes for great aerial photography.
It really does. But if you look closely at those job sites, down at the ground level, literally at the dirt, there is a completely different, totally unglamorous industry making all that shiny tech possible.
And it is a massively important piece of the puzzle.
Exactly. So today we're doing a deep dive into the newly released Q1 2026 financial results for a company called NPK International Inc. They trade under the ticker NPKI.
Right, and to give you a sense of our sources today, we're pulling from the company's official press release, management's business update, and, of course, the detailed financial tables.
Yeah, and the mission for you listening today is to show how a seemingly niche product like temporary recyclable composite matting is actually a massive hidden bellwether for global infrastructure and energy spending.
Which sounds a bit wild at first, right? Just temporary mats.
It does. Okay, let's unpack this. Think of NTK's matting as the literal red carpet for heavy industry.
I like that, the red carpet.
Yeah, because you simply cannot build a sprawling green energy power grid or lay a new pipeline if your 50-ton cranes and heavy equipment are just, sinking into the mud.
Right. And to really understand the scale of what we're talking about, we need to look at what NPK actually provides. I mean, they aren't just a manufacturer stamping out plastic sheets and dumping them at a construction site.
No, it's way more involved than that.
Exactly. They provide comprehensive worksite access solutions. So a typical transmission tower project might be located like miles off a paved road, right?
Across protected wetlands or maybe active farmland.
Yeah, and you can't just drive heavy machinery over that terrain without causing severe environmental damage.
Yeah.
Or getting your vehicles hopelessly stuck.
That would be a disaster.
A very expensive disaster. So NPK comes in during the upfront planning phase. They map out the logistics of moving thousands of these heavy composite mats to remote locations.
Wow, thousands of them.
Oh yeah, and they install them to create stable, load-bearing temporary roads and work pads. And crucially, when the project is done, they remove the mats, clean them,
Clean them. Why?
to prevent the spread of invasive species or soil contaminants. It's a big environmental compliance thing. And then they handle the site restoration.
That makes sense. It's the ultimate picks and shovels business.
It really is. They operate across critical infrastructure markets, electrical transmission, renewable energy installations, oil and gas exploration.
So if a utility company wants to build a transmission tower in a swamp, they literally have to call someone like NPK to even reach the site.
Precisely. And the financials for the first quarter of 2026 reflect exactly how much demand there is for that ground-level access right now. NPK generated $75.1 million in revenue for Q1.
That is a 16% jump from the exact same quarter last year.
It is. It's a huge leap.
And digging into that 75.1 million, it reveals two distinct streams of income. First, there are product sales, which is when customers literally buy the mats to keep.
Right, the traditional retail model.
Yeah, and that segment grew a solid 8% to $23.1 million. But the true driver of this quarter, the really wild part, was their rental and services division.
Oh, absolutely.
That segment surged 20% year over year to hit $52 million.
What's fascinating here is the disparity between those two growth rates. I mean, selling the product grew by 8%, but renting the product out and servicing it grew by 20%.
Right.
Matthew Lanigan, the president and CEO of MPK, he highlighted the sustained strength in rental fleet utilization and improved pricing in his commentary.
And he specifically called out utility customers and power transmission projects as the primary drivers there, right?
He did. Utility companies are changing how they approach their supply chains.
Wait, I have to push back on the scale of this for a second. $52 million in a single 3-month period just from renting out heavy mats and moving them around.
It sounds insane, I know.
Is this just a short-term spike from, a one-off government contract artificially inflating the quarter? Or are we looking at a structural shift in how utilities operate?
The data really points to a structural shift. The environment for power transmission spending is incredibly robust right now. It's driven by a dual mandate.
A dual mandate? How so?
Well, first, utilities have to upgrade aging, legacy grid infrastructure just to prevent failures. But at the same time, they have to expand the grid outward to connect new remote renewable energy sources
Hmm.
to, population centers.
Ah, right. All those new wind farms aren't exactly built downtown.
Exactly. And these projects take years from permitting to completion. So for a utility company, buying tens of millions of dollars of composite matting creates a logistical nightmare.
Yeah, where do you even put them all?
Right. You'd have to store it in giant yards, maintain it, and transport it themselves from state to state. It makes far more economic sense to treat this as an operational expense.
So they just rent the access solution from NPK.
Yes. They let NPK handle the transportation and the environmental compliance, and then just return the mats when the transmission line is finished.
You outsource the headache. I mean, the utility just wants the crane to get to the site. They don't want to own the temporary road it drove on.
Perfectly said. And because the pipeline of these transmission projects is so sustained right now, MPK's rental fleet is seeing very high utilization.
Meaning the mats are rarely just sitting idle in a storage yard somewhere.
Right. They're out in the field generating continuous rental revenue. And high utilization naturally gives MPK the pricing power that CEO Matthew Lanigan mentioned.
Oh, because when demand outstrips the availability of mats in a specific region, they can charge a premium for their services.
Exactly. It's supply and demand working in their favor.
Well, with revenue jumping 16% and pricing power improving, the logical assumption is that profit margins would scale upward right alongside the sales.
You would think so, yes.
But looking at the financial tables, there is a wrinkle here. Gross margin actually fell. It dropped to 36.2% in Q1 2026.
Right, down from 39.0% a year prior.
Yeah, and shrinking margins usually signal a problem with cost control, yet simultaneously they actually improved their operating efficiency.
Which is the confusing part at first glance.
Right. Their selling, general, and administrative expenses, their corporate overhead dropped by a fraction of a percent to 17.6% of revenue, and their net income landed at a very healthy $10.4 million.
That's about 12 cents per share.
Yeah. So they are profitable and they are running a tighter ship in the corporate office, but the actual physical cost of delivering their services went up relative to the revenue they brought in.
Well, management's commentary provides two specific reasons for this gross margin compression.
Okay, what are they?
First, they noted a modestly lower fleet utilization compared to the prior year period, but they characterized that previous year as exceptionally strong, perhaps even anomalous.
Okay, so a tough comparison year over year. What was the second reason?
The second, much more telling reason was an elevated level of cross-rental activity.
So what does this all mean? Let me try an analogy here to see if I'm getting this.
Go for it.
Let's imagine I run a successful car rental agency. It's a busy holiday weekend, and my best VIP corporate client comes to me needing a fleet of 10 SUVs for a retreat. But my lot is empty. Every SUV is already rented out.
Okay, a good problem to have, but still a problem.
Right. To keep that VIP client happy so they don't permanently leave me for a competitor, I literally walk across the street, rent SUVs from my rival agency at a premium, bring them back, and pass them on to my client.
Ah, I see where you're going.
It hurts my profit margins on that specific transaction, right? But it preserves my most valuable client relationship.
That analogy captures the economic reality of cross-renting perfectly. In the context of NPK, though, the logistics are just much heavier.
I would imagine.
NPK has a sprawling fleet of rental mats, but demand from these massive utility projects is intense and geographically widespread. So if a utility needs 5,000 mats in Texas next week, and NPK's nearest available inventory is currently deployed on a project in Ohio.
Oh, they have a major problem.
Exactly. When a major utility company is building a billion-dollar transmission line, they cannot pause construction waiting for mats to free up. Delays cost them millions in labor and penalties.
So NPK effectively has to rent mats from a third party to fulfill their own contract.
Yes, they secure third-party equipment or incur heavy freight costs moving competitor equipment to satisfy their customers' immediate needs. They absorb that higher cost, which directly compresses their gross margin for the quarter.
Wow. But it is a deliberate strategic choice, isn't it?
Oh, absolutely. It protects their market share, maintains their reputation as a reliable full-service provider, and keeps the major utility customer locked into the NPK ecosystem.
Rather than forcing them to establish a relationship with a competitor, which highlights an interesting tension. I mean, if they are forced to rent from rivals just to keep the lights on for their clients, their demand is painfully outpacing their current supply.
It's a high-class problem, but it is definitely an operational bottleneck.
Right. And realizing that NPK is straining the limits of their current physical supply, well, it contextualizes the most aggressive announcement in this quarterly report.
You're talking about the 50% expansion bet.
Yes. Because they are bumping up against the ceiling of what they can produce and rent out, the board of directors just formally approved a plan to expand their manufacturing capacity by 50% from current levels.
And we have to pause here because a 50% increase in physical manufacturing footprint is a structural transformation for a mature industrial company.
It's massive.
Yeah, they are altering the physical capacity of their business in a profound way.
And it is not cheap. They expect to invest between $40 million and $45 million over the next 5 quarters to get this new capacity online by mid-2027.
And keep in mind, that is on top of the nearly $15 million they already invested in fleet expansion just in this first quarter alone.
Right. It's a staggering amount of money for them.
It is. We have to look at CEO Matthew Lanigan's statements to understand why they are committing this much capital. He explicitly tied this $45 million expansion to his confidence in the durability of these trends.
The long-term structural forces in their end markets, right?
Exactly. Management is looking at the macro environment, the necessity of upgrading the aging electrical grid, the shift toward renewable energy sources that require new transmission corridors, and the ongoing federal infrastructure spending.
So they don't think this is just a flash in the pan.
Not at all. Yeah, they are concluding this is not a short-term boom. They believe this is a multi-decade supercycle of construction. Expanding capacity by 50% is a very loud, very expensive bet on the long-term future of the power transmission environment.
Here's where it gets really interesting, though. I have to challenge the timeline of this capacity build-out.
Okay, let's hear it.
They are already engaging in elevated cross rentals right now in early 2026. This new manufacturing capacity doesn't come online until mid-2027. Aren't they incredibly vulnerable to severe bottlenecks for the next year and a half?
Honestly, it is a genuine execution risk. Building a facility capable of extruding high-density polyethylene into industrial-grade, heavy-duty composite mats, it takes a lot of time.
Yeah, I mean, you can't just flip a switch.
Right. It involves acquiring real estate, securing permits, and installing custom large-scale manufacturing equipment. So for the next 5 quarters, management has to perform a delicate balancing act.
How do they even manage that?
They will need to optimize every single mat in their current fleet. They'll likely be relying heavily on logistics software to move inventory faster and more efficiently between job sites.
And I'm guessing we'll see more of those cross rentals.
Undoubtedly. As we saw this quarter, they will likely have to continue relying on some margin-compressing cross rentals to bridge the gap. They will just have to absorb those costs to ensure they don't leave revenue on the table or lose clients while they wait for the new factory floors to open.
Okay, but that brings up another massive question. How does a company generating $75 million in quarterly revenue fund a $40 to $45 million capital expansion without taking on dangerous high-interest debt?
It's the million-dollar question.
Yeah.
Or, well, the $45 million question.
Right, because in the current economic climate, taking out loans for factory expansion can cripple a company if demand softens even slightly before the factory opens.
But we connect this to the bigger picture. That question of financial vulnerability brings us directly to NPK's balance sheet. The financials reveal exactly why management feels secure making this gamble.
And the Q1 cash flow statement is really revealing here. Net income was $10.4 million, but their operating cash flow was $21.1 million for the quarter.
That is a huge difference.
It is. And it's a significant leap from the $8.8 million they generated in operating cash flow a year ago.
We should probably break down why there is such a large divergence between net income and operating cash flow, just for clarity.
Yeah, that would be helpful.
So, NPK is fundamentally an asset-heavy rental business. They own a sprawling physical fleet of composite mats. From an accounting perspective, those mats depreciate over time.
Okay, and depreciation lowers their net income on paper, right?
Exactly. Which is helpful for tax purposes, but depreciation is a non-cash expense.
Yeah.
They aren't actually writing a check for depreciation. The actual cash being generated by the daily business operations is much higher than the reported net income.
A cash is literally sitting in the bank. I mean, after paying for their operations and their initial investments for the quarter, their free cash flow was still $4.9 million.
It's an incredibly strong position.
And the crucial detail regarding debt is this. As of March 31st, 2026, they only have $10.6 million in total debt.
Which is an exceptionally low debt burden for an industrial company with this kind of revenue.
Yeah. Plus, they have 6.5 million in cash on hand, and they have an untouched $148 million available on their senior secured revolving credit facility.
It is a highly conservative capital structure demonstrating strict financial discipline. Because they are generating so much cash internally, they can fund this 50% organic growth entirely through their own operations and available liquidity.
So they don't need to beg the banks.
Exactly. They do not need to go to the bond market or take on high-interest loans to build this new capacity.
And as an added layer of confidence, they also used $2.7 million during the quarter to repurchase their own common stock.
That is so important to note. Buying back stock while simultaneously funding a major capital expenditure is a rare signal to the market.
Because normally you'd do the opposite.
Right. Often companies will issue new shares to raise money to build a factory, which just dilutes the value for existing shareholders. NPK is doing the exact opposite.
They're basically showing off.
Pretty much. They are signaling that they have more than enough cash to grow the physical footprint of the business, and they still have enough left over to return value to shareholders by reducing the total number of shares on the market.
And due to this Q1 performance and the strength of their balance sheet, NPK is actually raising its full year 2026 guidance.
That's the cherry on top.
Yeah, they now expect full year revenues to land in a range of $310 million to $325 million. And their adjusted EBITDA, which measures their core operational profitability, they expect that to be between $92 million and $102 million.
They recognized a physical bottleneck in global infrastructure construction, built a highly profitable business model to solve it, and are now using the resulting cash flow to aggressively widen their competitive moat before rivals can catch up.
So, for you listening, why should you care about a company that makes temporary composite matting? Well, NPK isn't just selling plastic mats. They are providing the foundational access required for the future of our energy infrastructure.
Exactly.
They are the logistical ground game making the physical transition of the electrical grid possible.
The next time you're driving down the highway and you see a transmission line being strung across a muddy valley or a wind farm being erected in a remote field, you will know there is a highly profitable, heavily utilized industry operating right under the tires of those heavy cranes.
And it leaves you with this to think about. If a company making unglamorous worksite access mats has to increase its manufacturing capacity by 50% just to keep up with the current pace of grid upgrades, what other hidden bottlenecks exist in our global push for green energy and infrastructure?
It really makes you wonder.
Are we, as a society, paying far too much attention to the shiny new technologies, obsessing over the efficiency of the solar panels and the aerodynamics of the wind turbines themselves, and not paying nearly enough attention to the literal dirt roads, the specialized heavy haulers, and the ground-level access points required to actually install them? Because if you don't have the red carpet, the show simply cannot go on.